The Federal Reserve raised interest rates by a quarter of a point at the end of its two-day policy meeting. A wide range of consumer finances, from mortgages and credit cards to student loans, auto loans and savings, will be affected by the rate increase. Here's a breakdown of the Fed's ripple effect on your monthly expenses and savings. The Federal Reserve raised the target federal funds rate by a modest 0.25 percentage points on Wednesday, after nearly 2 weeks of turmoil in the financial industry. Still, this marks the 9th consecutive increase in 1 year since the central bank began the current rate-raising cycle to combat rising prices. Over the last 12 months, inflation spiked to a 40-year high and then finally started to ease, but all of that monetary policy tightening has been tied to issues that are causing a banking crisis now. In the meantime, consumers must pay more to borrow while continuing to grapple with a persistently high cost of living, all while suffering a crisis of confidence when it comes to their savings. What the federal funds rate means to you, the bank problems are probably making a lot of people think twice, said Diana Furchtgott-Roth, an economics professor at George Washington University and former chief economist at the Department of Labor. People are not as confident, she said, referring to the wealth effect, or the theory that people spend less when they feel less well off than they did before. For its part, the Federal Reserve has been trying to rein in inflation by raising its benchmark rate. The federal funds rate is the interest rate at which banks borrow and lend to one another overnight. But that also influences consumers' borrowing costs, either directly or indirectly, including their credit card, mortgage and auto loan rates. Although 15-year and 30-year mortgage rates are fixed, and tied to Treasury yields and the economy, anyone shopping for a new home has lost considerable purchasing power, partly because of inflation and the Fed's policy moves. The average rate for a 30-year, fixed-rate mortgage currently sits at 6.66%, up from 4.40% when the Fed started raising rates last March. Other home loans are more closely tied to the Fed's actions. Adjustable-rate mortgages, or ARMs, and home equity lines of credit, or HELOCs, are pegged to the prime rate. Most ARMs adjust once a year after an initial fixed-rate period. But HELOC adjusts right away. Already, the average rate for HELOC is up to 7.76% from 3.96% a year ago. Homebuyers can greatly benefit from shopping around for additional rate quotes, according to Sam Katter, Freddie Mac's chief economist. Our research concludes that homebuyers can potentially save $600 to $1,200 annually by taking the time to shop among multiple lenders. How far will the Federal Reserve go to curb inflation? Will it cost the consumers more and more? Or will we finally see relief in the coming months as the peak season is around the corner? Only time will tell.